So I'm Steve Lentz with Discover Options and Option View. Option View has been in business since 1983, primarily involved in the high-end options analytics software niche. In Option View is a software program that models future theoretical of option prices very accurately. It throws everything, including the kitchen sink, at that issue as to determining future theoretical prices of options given certain moves of the market. But Discover Options is our educational arm where we provide one-on-one mentoring and options education, taking anyone from beginning, intermediate, up to as advanced as you want to go, and even we have money managers coming to us for assistance in their approach as well. What I want to talk to you today about, though, is trading volatility ETFs for exceptional returns. Just as a disclaimer, of course, presented material today is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. So take a look at this equity curve. Let me click here, there we go. So this is an equity curve of what we've developed here called the VXX Trading System. And this is for pretty much, this is just a year and a week, about 53 weeks. You can see at the bottom right corner, the return level was 246%. The annualized return was 241, and this is since we went live with our signals starting in March of 2016 through March 13th of this year. Now, going into March of 2016, we had done a lot of back testing. We had a previous version of this out, and we refined our timing and our indicators, and we went live with this in March of 2016, and we've been extremely pleased with the results, as you can imagine. And what I want to do today is explain to you what goes into the VXX trading system, why it works, what indicators we use. Of course, we have a service we provide. I'm going to show you all about that. And I think you're going to be very, very pleased at what you learn here today. It's a different angle. It's really diving into a different angle on the market that not too many people are aware of. So let's dive right into this and see what we're talking about here. Len Yates is the founder and president of Option View, and he developed the VXX trading system, which times the entry and exits for your capital in any one of three different ways. All right, you could be long the VXX, long the XIV, or your money would be in cash. Now, the VXX and the XIV are exchange traded notes, kind of like ETFs. They're exchange traded products. And you trade those much like stock. You can purchase the shares. It's very apropos for IRAs, 401ks, etc. And so your money would either be long the VXX or long the XIV, which is the inverse of the VXX, or in the cash. Now the VXX is the iPath S&P 500 VIX short-term futures, exchange traded notes. Okay, the XIV is the inverse. It's the inverse of the VIX. You're basically short the VIX. But I want to talk about the VIX. Both of these relate to the VIX. And if you're new to the VIX, let's explain what that is real quick before we move any further into this, because it gets to be kind of heady stuff. And this is important that we kind of back up to the beginning. So we have a price chart here of the SPX, the S&P 500 index. Now, that SPX has cash options affiliated with it, and those options trade well over $1 billion a day in volume. It's a huge market, and it's all traded at the Chicago Board Options Exchange. And for many years now, the Chicago Board Options Exchange has published a number called the VIX. Now, that VIX number that they publish throughout the day is a calculation of the volatility of the market. All right, the volatility of the market coming from what the price of the options are saying. So the options have certain levels of time premium, and so when that time premium gets really fat, okay, that VIX number is going to grow. And it's a 30-day volatility figure coming from the time value of those options. So think of this. So when the market goes down, all right, there's a lot of money managers with holdings, long holdings, and they want to purchase put options. So they're going to run into the options market and start buying puts to hedge their portfolios. Well, if all that community is starting to buy puts, that's going to drive the price of the options upward. The time value of those options are going to grow, and there's a measurement taken from that, the time premium there, called implied volatility. It's the volatility implied by that time premium going up when the market's going down like that. And so that's what I'm showing you here in the blue line there, is the implied volatility, or the VIX, and it's charted here with the price chart. So note this, when the market is going up, all right, when the market goes up, and hopefully you can see my little mouse here, you can see that the blue line is going down. And that makes sense, because in a bull market, now those hedgers, those folks buying put options, they're going to back off the pedal on buying puts, and they're going to start getting rid of them, and they're going to let the market take their long portfolio going long and making money. They don't want to buy insurance as aggressively as before in a bull market. So then the price of the options is, they're going to decline. The VIX is going to drop as the market goes up. Then when you see the market sharply drop is when you see the VIX go up dramatically. So there's an inverse relationship here between the VIX and the price of the S&P 500 index. Okay? Now, check this out. There is now a new market. It's not new. It's been around for a long time, but the CBOE, Chicago Board Options Exchange, rolled out futures contracts on the VIX. So if you wanted to trade the VIX itself, something you could do is now futures contracts on the VIX. So now these futures contracts have provided a very nice instrument for portfolio hedgers. Instead of buying puts, now they can go and go long the VIX futures. So if a portfolio manager is expecting a big break in the market or a bear market to continue, they could go long the VIX futures, because again, in a bear market, the VIX is rising, and they would go long the VIX futures to then efficiently hedge their portfolio. Okay, it's just another instrument out there allowing sophisticated portfolio managers to hedge their long holdings. So there's a huge market now that's developed around these VIX futures, and that's where the VXX and the XIV come into play. Okay, so with that knowledge, let's now go back to the VXX and the XIV. Both of them relate to the VIX futures. Okay, and so let's look at the VXX. If your money is in the VXX, that's an exchange traded note that manages a long VIX futures position. A long VIX futures position. Mind you, you are not trading the VIX futures yourself. Okay, instead you're buying shares of that exchange traded product, just like stock, and then your money is being used by a manager, all right, a VXX manager, to then manage a long VIX futures position. And it's done in a way that becomes very important. I'll get to that in a second. Now, the XIV is the inverse. Your money is instead used to manage a short VIX futures position. It manages a short VIX futures position. Okay, so and then your money can flop around in any one of these three places, along the VXX, XIV, or cash. Now, just as a precursor here, just full disclosure, we do have an advisory. We provide email trade alerts and signals. Everything you see here on the proprietary indicators, I'm going to explain very clearly what goes on behind the indicators, why they work, and we provide those with you as a subscriber, both in the member section of our website and also within our OptionView software. If you're a subscriber, you get access to that real time during the day. Also, we have monthly status emails, but I'll get to our service here more in a little bit. Back to the system itself. If you're going to trade this approach, I'm going to show you your VXX and XIV are both very liquid markets, and you should know that going in, that these aren't like thinly traded stocks, but the VXX averages well over 80 million shares traded per day. The XIV is over 30 million shares traded per day. So if you get an alert from us saying that the system is flashing a signal, well, be assured that you can go in and take a position fairly quickly with very little slippage. All right. Here is the core indicator going into the VXX trading system. We call it the Yates VXX indicator. What it is, it's a 15-day moving average of a component I'm going to explain very clearly here. All right. And basically, when this indicator, the 15-day average, and I'll show you in a sec, when it rises above a certain threshold, the system goes long the XIV. When it goes back down below that threshold, we go into cash. And in this case, we were in that position long XIV for about 3.5 months. Okay, so this system is not a swing trading system or a day trading system. This is a system where you are in a position anywhere from weeks to months at a time. Okay, in this case, we were in cash for 2 weeks before it went back long the XIV. It stayed long the XIV for almost 4 months before it went back into cash. Then we went back long the XIV back in mid-November, and it was long the XIV well, throughout the rest of this chart for sure. So what I want to do, though, is take these signals. I'm going to superimpose them on a chart of the XIV so that you can clearly see how well these signals did at firing off profits or losses. So take a look at this. We went long with these signals back at the beginning of March right away, and we got a signal on March 7th. So the system was in cash on March 6th. On March 7th, the system flashed a signal, and we went long the XIV at 21.18 that you can see there. We moved forward 3.5 months. The system exited into cash on June 23rd at 30.05. That was a gain of about 45% or so. 2 weeks later, we went back long the XIV, and we exited on November 1st at 35.82. That was a gain of what, 35%, something like that. And then it went long the XIV on November 16th. And on this chart going into the beginning of March, we went long at 40.45, and it was at, I think 67 at this chart here, a gain of well over 50%. So when you have gains of 40% there, 33% here, 50+% there, and every time you exit into cash, you're reinvesting at full strength, the maximum shares that you can buy, your money is going to compound. As you go into cash with your winnings, earnings, go back in at full strength, then when you can compound your cash that way. And when we back tested this and did that full reinvestment every time, had we started back in 09 with $10,000, the system now would have well over 3 million today. And you can see, if you look carefully at this equity curve, there are some flat portions where the system was in cash for a period of a period of weeks into cash, and that's important. When the system's flashing, stay in cash. You stay in cash, and and then it just levels out. You're not at risk, and then away we go with the next signal. So why does this VXX trading system work? What is the thrust behind it? So now that we've set our foundation of the VIX futures, here is the answer. It's called the daily roll. The daily roll, and it goes back to those VXX and the XIV. But I'm going to explain this daily roll very clearly. This is critical as to why this thing works. And we have to look at the VIX futures then. That's where this is all about. When we look at the VIX futures, in this case, an example from January through September, we can see that the price of the VIX futures ascends upward from January at 1220 going to September at 1925. This is called an upward price structure. And it's what you see typically in a bull market, because if you think about it, in a bull market, in the foreseeable future, in the foreseeable weeks, all right, in even months, we're pretty certain the market is going to stay bullish. And we know that when the market goes up, it goes up at a lower volatility level than what happens when it goes down, right? Isn't that right? When it's going down, if you've lived through a bear market like I have, right, we've got large daily ranges, we have gaps. Every day you're on pins and needles in those markets. We know what that's like. And in a bear market, things are kind of crazy. But in a bull market, it can be very staid. The daily ranges are much narrower. And so in a bull market like what you see in this price structure, in the foreseeable future, we're pretty certain we're going to have lower volatility. But the farther out in time we go, we could have a bear market, and we might have more volatility in that bear market. And that's why you see an ascending price structure here, an upward price structure. Now, in a bear market, what would this price structure look like? Well, it would be inverted. It could be completely inverted, right? So that you could have that 1925 number at the bottom could be at the top, and then it goes down. And that's because in a bear market, you have a short-term anxiety over where the market's going to go. But you know what? Long-term, 9 months from now, we're pretty certain that in time the market's going to settle down, and it'll resume its long-term upward trend with lower volatility in those bull markets. And so then we would have a downward price structure in a bear market like that, okay? So that's important to understand. Upward price structure is what you see. Inverted in a bear market would be a downward price structure. Now, to give credit where credit is due, I'm going to go to Larry McMillan. He presented this concept in his February 23rd of 2012 Option Strategist newsletter. He's a very famous options trading author. And I'm going to read you verbatim what he wrote, because we got his newsletter in the office and went, wow, this is awesome. And Len Yates then flushed out details of this system using, coming up with some indicators I'll show you in a bit, and really systemizing this concept. But here it is. This is the original verbiage that Larry himself used to explain this concept. So I'll just word for word, let's walk through this. Both the VXX and the XIV are constructed in such a way that they actually own, like in the VXX, or are short, like in the XIV, the two VIX nearest month futures. Very important. Each day, part of the position is rolled forward so that a constant 30-day forward position is simulated. Now, when the term structure slopes upward, like what I just showed you, which it does most of the time in a bull market, that daily roll is a debit and is a drag on the performance of the VXX. I'm going to show you an example of this in just a second, so don't worry. I'll make it very clear. However, since the XIV is the opposite, it is a boon. That daily roll is a boon to the XIV. Conversely, when the term structure slopes downward, like in a bear market, what I just explained, the daily roll forward for the VXX is a credit, allowing it to outperform the VIX. Okay, and consequently is a detriment to the XIV. Let me show you an example of this. Left side of the screen, go to the left, you'll see the VXX long front 2 months. See that? Now, remember, if you have money in the VXX, your money is being used to maintain a long VIX futures position. Your money is loaded up in the front 2 months. All right, that's what the VXX by definition is doing with your money. It's managing it in a long front 2 months position. Every day though, it has to be rolled because it's simulating a 30-day forward position. Now, if you're long, that means that you're going to have to peel off a little of Jan and roll into a little bit of Feb. That means you're selling a little bit of Jan, buying a little bit of Feb under the VXX on the left side of the screen. And if you were to sell Jan at 12.20, you see that, and buy Feb at 14.20, that's a debit. You're selling low and buying high, and that is going to be a drag on the price of the VXX. So if you're long the VXX, every day you know, it's kind of like being in you're in a sailboat and the sail's in the wrong direction. All right. So, but go over to the right side of the screen, XIV, where you're short. Your money is being used to manage a short position in the VIX futures. You are short the front 2 months futures. You're managing a short position every day. Then we have to peel off Jan, roll it into Feb, meaning we have to buy a little of Jan, sell a little of Feb to maintain our short 30-day forward position. That means we're buying low and selling high, and that net credit is then helping out the price of the XIV. And I'll tell you what, I'm going to show you near the end here, it can really add up. Bottom line, it can really add up, and that's why we do this. So there you have it. The daily roll in this upward price structure is benefiting XIV. Now, let's go back to Macmillan, because he then continues. The idea behind the trading system is simple enough. When the VIX futures slopes upward steeply enough, that's a roaring bull market, and we want to own the XIV. That means we want to be short the VIX because that daily roll is beneficial and because VIX is expected to decline. On the other hand, when the slope is downward, like a bear market, we want to do the opposite. We want to own the VXX because the market's bearish, VIX is increasing, and the daily roll then is beneficial to the VXX instead. So folks, it's kind of like being in a sailboat. We're going to wait till that daily roll gets really strong in one direction, and then we open up the sail and ride the wind. Okay? If the daily roll is benefiting the XIV, we're going to open up the sail. We're going to go long the XIV and ride that daily roll as long as it exists. When the daily roll goes down and the wind stops, well, we're going to pull in the sail. We're going to go into cash, and we're going to wait there. We're going to wait to see which way the wind goes, which way the daily roll is going to then benefit us. If the daily roll doesn't get to a good level, well, we're in cash. Okay, and that's important. And so that's kind of the theory here. And so, but every good sailor has good navigational tools. What do we use to navigate our way through all this? And in option view, we call it the VIX diff. The VIX diff, it's a difference in the prices of the front 2 months VIX futures contracts. Okay, so and this is unique to option view. We've calculated this, and basically in this example, look at it closely. In this upward term structure, Feb minus Jan 1420 minus 1220 is equal to 2. Okay. In an upward price structure, if this was inverted and 1420 instead was above the 1220, we could have a negative number here in an upward price structure, but we can't, because we can't carry a negative number in our last column in our quotes display, because you know stocks can't go down below 0, although some maybe should. There's a little joke, but in any case, what we do is in option view, we post that difference in the change column 2, and then we use 10 as a base 0, so that if the price structure is downward and it's a negative VIX diff, the difference between those front months, well, then we would be underneath 10, something in the 8s, the 9s, etc. Okay, so 10 is base 0, and then what we've done at option view is we've gone back many years. We have actually calculated the open, high, low, and close for every day going back years and years so that we could back test this thing, the VIX diff, the difference between the front 2 VIX futures contracts. Isn't that something? Okay, just it's all software, it's all ones and zeros, as they say, right? You just program a computer and away it goes. And so we've done a lot of work here to get this data. Now, what do we do with this data of a VIX diff? Well, we will originally, and you can apply a 15-day simple moving average to this and use that as a simple timing indicator. And this was originally, years ago, our original indicator, but over the, over a couple years time, Len Yates really refined this. And we discovered that if you took a moving average here and adjusted it for volatility, you could really get a much more refined signal generator using some adjustments to that moving average. And so what we have today, instead of using a simple 15-day moving average, we're using a 15-day moving average of the VIX diff but we're proprietarily adjusting it for volatility. And so now with this, when this indicator then goes above a certain threshold, 0.83, we go long the XIV. When it crosses back below 0.83, we exit back into cash. Okay, on the downside, and that's the you know, the green arrow, the green line you see across the screen, the green dotted dash line, that's the 0.83. When it goes down below negative 0.6, okay, we go long the XIV. When it comes back up above negative 0.6, we're into cash. Here's an example from 2011 where the indicator went down below 0.6 for about 3-4 months, came back above, and we exited into cash. Let's just go to a price chart of VXX back then. You'll see back in 11 when this happened, the system went long the VXX at 15.5, exited what, 3.5 months later at 23.44.5 for a gain of 50% or more. All right, beautiful, beautiful. And so, you know, that's kind of, that's one example of being long the VXX. Finally, just as a final point here, just wrapping up the premise, we want to be in a position to take advantage of that strong daily roll. That's where we're always coming down to. How big can that daily roll be? All right, let's go take a look at just an example. And I'm using this from January 13th and look at the top line. The XIV at the time was at 55.23. And so in option view, and you have access as a subscriber to this data, the daily roll effect for that day, if you were long the XIV, okay, the daily roll effect, that credit we were talking about, was basically at 36 cents. So how much is 36 cents when the XIV is at 55.23? When you run the numbers, that turns out to be about a 0.65% gain, just simply wrapped up in that daily roll. This is on a calendar day basis, so times 30 days, at that pace of 36 cents, that's a pace of 19.5% per month. Now, 36 was not at the highest end. It's in the upper range of what you'll find daily rolls to be. It wasn't at the top end. It was kind of at the lower part of the higher, quartile or something like that, right around there. Okay, so it was a strong number, but that's when we want to be in, is when it's strong. And then if it's weak, if it's not there, well, then we're not going to, the system will be in cash then. All right, so that's significant. And you can see if you're always in the market in the direction of a strong daily roll, getting upwards of 19.5% a month at that pace, you can see how your money can then compound when you go long-term with this thing. You can have drawdowns, of course, and we are upfront with that about folks, that the system has had drawdowns of, I think the max was like at what, 33%, something like that. This since March, it was, I think 22 was the greatest one. So there is volatility involved, and if you do have money set aside for some volatility, but you can allocate it towards something like this, that would be ideal. Just understand you have some, you do have some equity line volatility in return for potential great returns like this. Okay, so where would you go now? All right, where would you go now? I've explained the concept and the systems. We ask that you go to our website at VXXTradingSystem.com. I just gave you an introduction. We have an ebook for you to register for. We will get you an ebook that explains all this in a narrative written format. We also have 2 more videos for you to watch. Len Yates himself did some fantastic videos that had they have animations and just does a great job of explaining the daily roll, the necessity of portfolio managers to hedge, why this opportunity, this system has to work, because as long as there's volatility in the market, something like this is going to work. And as long as the VXX and the XIV are trading, or something like those are trading with that forward roll, you have opportunity there. So you can register for the ebook, watch the videos. That's the next step in educating yourself if you want to pursue this. And then now you can go to our website, VXX Trading System, and subscribe. It's $1,200 for the year. And what you get for that is emailed trade alerts throughout the day, and we'll send you an alert. If the system's firing a signal, you will get an alert in the middle of the trading day, if not earlier in the trading day. And you will have plenty of time to make your adjustment to your position, you know, either get in or out or whatever, but well before the close. We give you access to all the indicators that I showed you and more through both a member section of our website and also within the software, OptionView software itself. And then we have monthly status emails going out as well. Here's a screenshot of what our members see on our website. And this is as of the close of this particular day in March. We're kind of come out later. We're working on it now to have live updates of all these indicators for our members. And what you'll see here are all the futures markets with their upward price structure that you can see. The daily rolls. We also have a danger indicator explained in the second additional video, and you may have seen those purple lines, and those are for more discretionary traders that want to you know, go beyond just trading the raw system itself. But all this is available in OptionView in real time if you're a subscriber to OptionView. But right now, we'd ask that you go and watch the extra 2 videos and read that ebook and educate yourself before pulling the trigger and becoming a subscriber. Also, if you have any further questions, see, is there a phone number here? No, I don't see one. Well, let me write that down. 847-816-6610. For other questions, we have reps that can handle all the tough questions you might have. 847-816-6610. And there you go. I went 2 minutes past. All right. Let's see here. What do we got? Trying to, there we go. Let's see. This is an interesting question. Both the XIV and the VXX have high expenses, and I think other charges. Can you show gross return as well as net? Wouldn't they hamper returns of the longer duration holds versus shorter returns? You know, I'll be honest, and this is kind of where, you know, those expenses, well, no, everything I showed you now is net of those expenses. Because you're just buying and holding, and you're not in, you know, I'm not familiar with those expenses as much as maybe I should be. But everything I'm showing you here is just simply going long the XIV and holding for those 3.5 months in those signals that occurred. So keep that in mind. We're just simply, you know, I mean, if we could quantify those expenses, and also what's the alternative? There might be a few alternatives, but the daily rolls are quantified right now in our system using these 2 underlying assets. All right, what's another question? Boy, I am trying to get this worked out so I can see. Boy. Question. All right. You know, I'm having to use a microscope almost to see my the questions and everything. All right. Goodness. Well, I apologize. I cannot. Here, let me. All right, there we go. Now I can bring this down. There we go. All right, expenses. Can you hedge a long VXX XIV position with options? You know, you can hedge those with options. We do not recommend that you do, Peter. Our testing, back testing and forward testing, you know, we've looked at other option positions within the VXX XIV signals. Nothing compares to the returns that we've had from the core system itself. You can't see this? Okay. Can you use it on TOS? Yes? Oh, well, you can, certainly. Yeah, if you have an account at TOS, you can buy and sell VXX XIV there. But our indicators are within the OptionView software, though. All, you know, the VIX diff, all those other, the danger indicator, etc. Those and the daily roll effect, those are all unique to stuff that we've developed in-house and broadcast to our OptionView subscribers. Okay. Let's see here. What is the lowest price for overnight margin on any VIX product futures? Well, I got Jim here. He's our Chief Executive Officer. Yeah, no. Yeah, this is you're just buying. You're just going along the VXX and the XIV. You are not taking a futures position yourself. Okay, you're just going along the shares of those exchange traded products. So margin isn't going to come into play.